Hi, I'm Pattu from FreeFinCal, and if you want to invest in gold this year, watch this first. So, every year when the stock market becomes volatile and kind of starts to fall down, gold usually, not all the time, but usually tends to strengthen. And last year was not an exception. Gold returned about 7-8%, and the large caps returned about 3-4% less. The mid and small caps fell by big amounts in India. So let's look at the risk and reward of gold and compare it with Sensex, and also let's compare it with a index which is representative of the debt mutual funds. So we will start with 3-year rolling returns. So that is, we are going to look at every possible 3-year period on a daily basis between 1979 to January 1979 to January 2019. So the yellow line is gold in all the graphs. The pink is the Sensex price. The dividends are not included. And the white line is the VR, the Value Research Bond Index. It's representative of the many of the debt mutual funds, kind of income mutual funds, what they call income mutual funds, or what do you call it, corporate bonds and so on. So it's an approximate measure of fixed income instruments. Don't take it too literally. It's just an approximate measure. Now the Sensex has a dividend history of anywhere between 1 to 2% depending on the duration. So even if you assume it as 2%, you will have to reduce some money for expenses of investing, and then taxation. So I would say you have to push this pink graph by 1%. Just push it up by 1%. Gold taxation is not accounted for in the returns, so you'll have to push it down by at least 1%. Again, fixed income taxation is not accounted for, so let's push down by 1%. So we'll remove taxation out of this. Expenses are also not accounted for. The only problem is the dividends have to be added for the Sensex, and that would mean pushing it up by anywhere between 1.5 to 2%. So be careful, and always keep that in mind when you look at the graphs. We're going to keep looking at this again and again and again for different durations. So that's over 3 years. The number of data points in the Sensex curve is shown here. That's like almost 6,000 data points. And you can see that the Sensex over 3 years has been quite volatile in terms of the returns. And you can see the spread in the returns. So pause the graph, pause the video for each duration, and you notice the spread in the returns on the y-axis. The end date of the investment is shown here in the x-axis. So the white line is the fixed income. So you can notice that the Sensex is much more volatile here for this period and the gold. I have done a previous study where I've shown that if you actually look at the gold price from 1925 and look at 5, 10, 15, 20 and 25 year durations, the gold volatility is a little higher than that of Sensex. But for this duration, this is the result, and this is the rolling risk or the rolling standard deviation data. So we look at the daily prices and find out how much the daily prices deviate from the average daily price. Notice that for 3 years, the gold price and the Sensex price are more or less comparable. The Sensex is a little bit higher. Adding for the volatility, the adding of dividends does not make much of a difference. So the volatility will be the same. So there are times when the gold has been a little bit more volatile than the Sensex, but the Sensex is just a little bit high, but not too much. Now compare the in all the graphs it's going to follow. Compare the volatility of gold with the fixed income. Now this big jump here, that's I think it's artificial. Probably 1 or 2 data points are bad. Don't worry about this mean here. I think that's the typical fixed income kind of volatility. Notice how low it is. Although it's low, notice that its return is more or less comparable to both that of Sensex and gold. So over 3 years, the clear choice is fixed income. There's no doubt about that. Now let's move on to 5 years. Again, that's quite a bit volatile. Keeps moving up. You can get negative returns in gold over 5 years. Fixed income is more or less around 8, 9%, 7% or so on. Again, the volatility over 5 years. Again, the volatility of the pink and the yellow lines are comparable. The fixed income is significantly low volatile. But again, going back to the returns, notice that even though the fixed income is less volatile, the reward is comparable to that of equity and gold. So don't assume that 5 years is long term, and don't say more the risk you take, more the return you will get. That is complete nonsense. So that's 5 years, and now let's look at 10 years. Again, over 10 years, you can notice that there's a huge spread in gold risk. Of course, naturally, the stock market is also risky, but recognize that the returns keep in mind the 1.5% of dividends that has to be pushed up for the pink line. The fixed income again is comparable to gold and Sensex during some periods. And the volatility, now you can see that the pink line is kind of moved up a little bit comfortably, and the gold is a little bit lower, but not too much lower. That's very important. The gold is a touch less volatile than Sensex for this duration studied, but it's still just a little bit less and significantly higher than fixed income. Again, over 15 years, you can notice that there's not much of history for the fixed income, so that's why you don't have the white line stretching up out here. But you can notice that the spread in gold returns is huge, and the fixed income, if I assume it's kind of at that level, fixed income is still able to give comparable returns to that of gold over 15 years at significantly lower risk. That's the biggest problem when it comes to gold. You're taking too much risk, because there are two commodities when you buy gold in INR. This is gold price in INR, excuse me, I have not mentioned that. The problem is that the forex fluctuations are added in, and then there is the gold price fluctuations in USD as well. So there are two commodities that are adding up and causing a enhanced volatility of gold price in INR. That's about 20 years. Again, notice that now please tell me, if you look at this graph, what return can I get by investing in gold for 20 years? It's gone anywhere between 10% to 2% or 1%. I don't know. That's the answer. I don't know. It's completely unknown. The volatility is too high. Of course, naturally, the stock market volatility is high. The bond data is not much, but it's just around that, just 7-8% or so. You can assume that the return is fixed income return. Just take PPF return if you want. Just take it as 8% or 7%. That's enough if you are worried about that. And the volatility of the bond, look at that, is practically nothing. It's like 1%, almost or so. Look at that. Gold is little less volatile than Sensex for this period, but it's not that less. And it is not giving you for the kind of reward. Look at this gap between fixed income reward and gold investment reward. For that gap, the return gap is not that much, right? By taking so much more risk than fixed income, you're not getting a higher reward. You're actually sometimes getting lower reward. That's the problem. And this is 20 years. There's no long term. For gold, there's no long term, short term. It's always volatile. And that's again, that's what I just showed. Now that's 25 years. Now the fixed income data is not available, so it's moved out of the picture, although there's a legend, don't worry about that. Again, look at that huge spread in gold returns. And Sensex is kind of, at least if you add the dividends, the Sensex will be about 10% over 25 years. So expecting 10% from the Sensex over the next 25 years is not a terrible deal, at least from the Sensex. But anyway, 10% before tax. The standard deviation over 25 years, now the standard deviation is kind of tending down, but not too much. It's just a little bit less. But the fixed income standard deviation would be here. And if you go back up, 8% or 7% fixed income would be here. Still, you can notice that the gold is only a little bit higher or comparable to fixed income at times or less. So that's the problem. There's no commensurate reward for the extra risk that you're taking when you invest in gold. So that's 30 years. Again, huge. The lowest over 30 years is still about 4 or 5%. Come on, 5% return after 30 years of investing, after enduring that much volatility is not worth it. It's completely not worth it. At least for the volatility that you are going through in the Sensex price, even without adding dividends, the 30-year returns are pretty decent. So, and if you add them, it will be high. So please keep that in mind. Should gold, that's 35 years, again the same story. Again, there's a huge spread. Again, the same risk. Now, that's the problem. I mean, should gold be part of your portfolio? It depends. If you are going to buy and hold, let's say I'm going to have almost, let's say 20% of my portfolio is going to be gold and I'm going to rebalance it every year. Is it even worth taking risk for that 20% when you're not going to get, commensurate reward? You can, that 20% could be a fixed income. You can sleep more peacefully and you can get decent reward with fixed income, right? Like PPF or even a debt fund, which will, a liquid fund will give you decent returns. Why bother? Unless, don't add gold to your portfolio unless you're ready to time the market with technical indicators and tactically asset allocate depending on moving averages or whatever, Bollinger Bands, whatever, something. So you must be ready to do that. Otherwise, don't do it. Please recognize that investing in gold means it is part of your portfolio and you're investing it for diversification and you're looking at the portfolio return, and that portfolio return should be stable, not high or low. The volatility in the portfolio return is made more stable by adding gold as a diversification element, provided you are able to rebalance it. But then the point is, individually it's too much risk. It's painful to hold gold. If you are going to tactically asset allocate, the risk will come even more or less. The volatility in the portfolio return will lower even down. But that doesn't mean you will get higher risk, higher return. Don't assume tactical asset allocation will give you higher return. That is not the reason why you should do tactical asset allocation. So that is the essential point you should keep in mind before you invest in gold, before you track the price of gold, before when you buy sovereign gold bonds. As an investment, that is when you are looking for reward. I had made another video where I said if you want to accumulate gold for a future purchase, then you can buy a sovereign gold bond or a gold ETF and track the price of gold without any risk. That is different. That is meant for a future purchase of gold. This is, I'm talking about plain investment, and again, it's simply not worth it. So I'll catch you in another video.